Here is a ranking of the major federal loan repayment programs from worst to best, along with an explanation of why I think that. Now, I'm not going to get into the nitty-gritty of the different versions of each. There's actually probably more repayment programs even than I'm describing, but I want to hit the major ones so that you can see which ones that you might be on may or may not be a good idea. So the worst federal loan repayment program that's not forbearance or deferment, because that's not a repayment program, you're just watching the balance balloon, is the extended program. This is a program that allows you to put it on a fixed 25-year type schedule, and if you're on this program, it's because you want to pay less than the standard 10-year, because that's the one they'll default you to if you don't say anything. So if you want to pay less, there's a really simple solution to that. Okay, it's called income-driven repayment programs. So the extended program is usually used by people who are not aware that they have other options available and who are concerned that they don't want to pay too much on their loans, but eventually they want to pay them off. So it's just basically the extended program is kind of a proxy for folks that have really not ever thought about any kind of organized approach to their student loans. The graduated program is also a bad program, but it is the second worst program. So the graduated program is one that allows you to pay less now and more later, so that you can pay your loan off gradually over time. Hence the graduated moniker. So the graduated loan program can come in a variety of lengths, but the one that a lot of people will try to do is the 30-year graduated loan program when they'll consolidate their loans. Now the graduated program, again, is a program where people are worried about their monthly payment. Now this is not a good program to be in because generally people that are having problems with their monthly payment are also making a lower income. So if you have struggles with making your student loan payment, then perhaps you need to be signed up for a different program. The next program to talk about is the Income Contingent Repayment Program, or ICR. ICR is a program that requires 20% of your income after deducting for the federal poverty line. This is a lot of income to be paying towards your student loans. The only people that should be using the ICR program are borrowers in the Parent Plus loan program. That's it. If anyone else is using the ICR program, there's probably some sort of loan servicer error that's giving you a lower payment than they probably should be calculating. So the Income Contingent Repayment Program is generally not a good program to use. The Standard 10-Year Program is a program that allows you to pay your loans off over 10 years. The most useful aspect of the Standard 10-Year Program is using that for public service loan forgiveness if you have an income that's too high to qualify, except under the usual income-driven options. So that's really the only reason you should use Standard 10-Year. The Standard 10-Year is only available on loans that you've not consolidated. And the Standard 10-Year Program generally means you have enough money to pay your loans off, and if that's the case, then you probably should be refinancing instead. The next on the ranking from worst to best is the Standard 30-Year Program. Now this makes sense for people who have a very low interest rate on their federal student loans. This is typically people that have loans from the early 2000s, and if you consolidate your loans, this is how you get access to the Standard 30-Year Program. You pay a flat monthly amount to pay your loans off over a 30-year amortization schedule, kind of like a 30-year mortgage. And that makes a lot of sense, honestly, to use that program if you have a very, very low interest rate. The problem is a lot of people that use this actually have a high interest rate and are trying to pay their loan off, but they can only afford to do it over a 30-year time schedule, which makes that Standard 30-Year Program bad, just like the other programs we previously reviewed are not the optimal plan to choose. Next on the list is Income-Based Repayment, or IBR. IBR is a program that is 15% of your income, and they give you a better deduction than the Income Contingent Repayment Program does earlier. So the IBR program is lower, and it's also a 25-year program, and you can use it for things like public service loan forgiveness or just forgiveness in general after 25 years, where you might have to pay taxes in the forgiven balance if you're in the private sector. The IBR program was the very first major income-based program that exists, hence a lot of people tend to swap out the term IBR for income-based repayment kind of interchangeably, even though income-based repayment options are more broad than that specific program. The second best income-based option is Revised Pay-As-You-Earn. Now this is the second best program overall if you're counting in the federal repayment programs ranked. Now the Revised Pay-As-You-Earn program has interest subsidies where if your payment is below the monthly interest that accrues, the government pays 50% of the remaining interest that your payment doesn't cover. Now you can by all intents and purposes, also pay extra on top of what you're required to pay and still get that subsidy, since it's calculated on a monthly basis at the beginning of the 12-month period that your certification is good for. So most people that have a low income but have extra money to pay would be really well served in the revised pay-as-you-earn program to keep that required payment pretty low so that they can make excess payments and have a lot of that go to principal. So the revised pay-as-you-earn program is a good program to have. It's also a better program than income-based repayment if your only option is revised pay-as-you-earn, because it's 10% of income versus 15% of income for IBR. Now, the best federal repayment program that I think a lot of people need to consider is called Pay-as-you-earn. The PAYE, or Pay-as-you-earn program, is a program that is 20 years until forgiveness. It's 10% of your income. There are no interest subsidies like under the revised Pay-as-you-earn program, but there is a positive about Pay-as-you-earn besides just that it's 20 years until forgiveness instead of 25. A big positive that's very overlooked about this program is you're allowed to file taxes separately from your spouse and have only your income counted instead of both of your incomes counted. That is a major deal. It's a major positive, so that you're able to basically pay only on part of your household income instead of all of your household income. The revised pay-as-you-earn program, in contrast, counts your entire household income no matter what. Now, recapping, ranking from worst to best, we've got the worst: extended, graduated, ICR, standard 10-year, standard 30-year, the IBR, the repay, and the pay-as-you-earn programs. Now, these programs can often be used in various situations for people in different ways, and if you are confused, as a lot of people might be watching this, feel free to reach out to us for a custom student loan plan. That's what we specialize in for thousands of borrowers. So studentloanplanner.com is the website to visit for that. If you have questions, or if you want to disagree with the ranking of worst to best federal repayment programs, or if I left one out, feel free to comment in the comments below.